Welcome to this explainer. Grab your spreadsheets because today we're putting on our sell-side equity analyst hats to build a rigorous, bottom-up fundamental valuation of a massive emerging market powerhouse, MercadoLibre. We are completely stripping away the noisy financial headlines and basing our analysis exclusively on their latest filings. Because, as we know, if you want to find out what a company is actually worth, you have to look under the hood at the raw, unfiltered data. Let's jump right in. So let's start by addressing this massive market dissonance. The financial news aggressively reported that MercadoLibre stock tanked 7% right after earnings. But wait a second. At the exact same time, their Q1 2026 presentation showed a total payment volume of a staggering $87.2 billion. That is up 50% year over year. So why the severe punishment from Wall Street? It's a genuinely fascinating valuation puzzle. The market is clearly spooked by something hiding just beneath that massive top-line growth. To figure out the true intrinsic value of this business, here's our roadmap. We'll hit the catalyst, analyze the business moat, lay out the financial foundation, derive our free cash flow, set our WACC assumptions, and finally, deliver the verdict. First up, the catalyst. Revenue surging while margins compress. There is a stark contrast happening in the current numbers. Top-line revenue is absolutely exploding, up 49% to $8.845 billion. But look at the bottom line. Operating income actually dropped by 20%, bringing it down to $611 million and compressing the margin. Management is making a very deliberate, conscious choice here. They're sacrificing short-term profitability to aggressively fund their long-term ecosystem. As analysts, our job is to figure out if that capital is actually being deployed efficiently. Moving on to part 2, our pre-valuation deep dive into their business moat. The annual report clearly lays out their revenue engine, and this is absolutely not just a basic e-commerce site. It's a heavily entrenched ecosystem. The vast majority of their gross merchandise volume comes from their third-party marketplace. Notice how they strictly limit their first-party direct sales to less than 10% of GMV. Why does that matter? Well, it lets them maintain price competitiveness without taking on massive, risky inventory themselves. Add in their proprietary logistics network, Mercado Envios, and you've got a heavily fortified competitive moat. And then there's the fintech side of the business, Mercado Pago. Originally, this was just built to help process their own marketplace transactions, but Pago has become an absolute beast in its own right. In Q1 2026, their acquired total payment volume drove a staggering 87% year-over-year growth. They aren't just processing online shopping anymore. They're rapidly becoming the dominant digital financial infrastructure for all of Latin America. But where exactly is the money being made? Digging into the segment structure on page 50 of the annual filings, we uncover a crucial geographic dynamic. Brazil is the undisputed volume leader, pulling in $15.2 billion in revenue, but it runs on a relatively tight direct contribution margin of 13.7%. Now look at Argentina. It brings in $5.9 billion in revenue, but it delivers a massive 41.6% margin. That heavily skews their overall profitability and exposes a really critical risk factor. Any major currency devaluation in Argentina is going to disproportionately hammer MercadoLibre's bottom line. All right, Section 3, laying our financial foundation and establishing the base year. Straight from the non-GAAP tables in the annual report, we peel back the accounting layers to establish our 2025 baseline. We start with a reported net income of $1.99 billion, but by adding back non-cash charges, specifically $818 million in depreciation and amortization, plus taxes, we arrive at a very healthy $4.019 billion in adjusted EBITDA. This absolutely proves the core cash generation of the business is incredibly strong, which is an entirely separate story from the recent quarterly margin noise. Section 4, the absolute core of our model, deriving free cash flow for the DCF engine. Now we build out our unlevered free cash flow bridge using explicit data from the 10K. First, we calculate NOPAT by applying their 29.7% effective tax rate to operating income. Next, we add back that non-cash depreciation charge of $818 million. Then, and this is vital, we strictly subtract the $1.327 billion in capital expenditures. You simply cannot value a hypergrowth company like this without deducting the massive real-world cash required to actually build the physical warehouses and tech infrastructure that sustain the growth. And jumping over directly to the cash flow statement, it validates our assumptions perfectly. The company generated over $12.1 billion in operating cash in 2025. But notice that heavy deduction of $1.327 billion in property and equipment. That is the literal, tangible cost of building out the Mercado Envíos logistics network. They are aggressively, relentlessly spending cash today to widen their moat against regional competitors.
Section 5. Applying our WACC and terminal growth assumptions to bridge the gaps in the filings.
To discount those future cash flows back to today, we need to confidently calculate our cost of capital. We have the hard numbers for our cost of debt from the filings, like that $160 million interest expense. However, because a 10K inherently does not state a market risk premium, we must apply sensible professional defaults. We're assuming an equity risk premium of 5 to 6%. And for the terminal value, calculating those cash flows into perpetuity, we assume a 2.5% growth rate. This explicitly aligns with the long-term GDP expectations of their primary Latin American markets.
Finally, Section 6, the verdict, valuation, and our final thoughts.
Bringing all our fundamental numbers together yields a pretty profound realization. That $8.845 billion Q1 revenue figure proves one thing definitively. The growth engine is entirely intact, and users are adopting this ecosystem at record rates. Therefore, our fundamental intrinsic value relies heavily on one single critical assumption. Will management's incredibly aggressive spending today actually yield unassailable monopoly-like margins in the terminal period? We've built this model based strictly on the filings, and the math tells a clear story of a company prioritizing absolute ecosystem dominance over quarterly profits. So I leave you with this final thought. If you believe those billion-dollar CapEx investments will cement them as the undisputed e-commerce and fintech monopoly of Latin America, then this recent 7% stock drop might just be a brief, tiny blip on a very long, very profitable timeline. But if competitors manage to breach that moat, those squeezed margins could be here to stay. Thanks for joining this explainer, and we'll catch you in the next one.